Welcome to Macroeconomic Conversations with Bilal Hafiz. We aim to bring you the best macro analysis to help you successfully invest in financial markets. For our latest analysis, visit macrohive.com. It's been another huge week with the Fed delivering one of the most hawkish meetings in years. We've changed our view on the Fed as a result, so check out Dominique's view on the Macrohive site. We also look at the history of equity corrections and give our take on how to position in this era of equity volatility. Then on crypto, we update our view on Ethereum. Things could be turning up. Our Explainer series has been wildly popular, so check out our latest one on central bank digital currencies, or CBDCs. As a Macrohive member, you can get access to all of our investment-focused analysis, our webinars, podcast transcripts, and our member Slack room, where you can interact with the Macrohive research team and other members all hours of the day. You can sign up to become a member by going to macrohive.com. Membership to Macrohive costs the same as a few weekly cappuccinos. So go to macrohive.com to sign up now. And if you're a professional or institutional investor, we have a more high-octane product that features all my views, our model portfolio, trade ideas, machine learning models, and much, much more. Hit me up on Bloomberg or email me on bilal@macrohive.com. That's Bilal, B-I-L-A-L, @macrohive.com to find out more. Now, on to this episode's guest, Adam Iqbal. Adam is a managing director and global head of G10 FX options trading at Goldman Sachs. Before Goldman's, he was an FX Volatility Portfolio Manager at PIMCO, and he worked as a vanilla and exotic FX options trader at Barclays Investment Bank in London before that. He's author of two books, the upcoming Foreign Exchange, Practical Asset Pricing and Macroeconomic Theory, and an earlier book, Volatility, Practical Options Theory. Adam holds a PhD in financial mathematics and economics from Imperial College London, a master's in applied maths from Oxford, and a master's of science and bachelor's in physics from Cambridge University. He has held a visiting academic position at Imperial College London and has guest lectured at the LSE. So clearly a very smart person. On to my interview. So greetings, Adam. It's great to have you on the podcast. I've been looking forward to this conversation.
Hey, Bilal. Thanks for having me on. Pleasure to be here.
And before we jump into the meat of our conversation, which I'm really looking forward to, I always like to ask my guests their origin story. So what did you study? Was it inevitable you'd end up in finance, and your career journey until now?
Yeah, so I started with an undergraduate degree in physics at the University of Cambridge. And when I think back to that time, I actually remember quite clearly not understanding why somebody would want to even study economics or finance or the subjects that I eventually fell in love with. At the time, it felt like the questions in physics were just so much bigger and more important, right? Things like, what's the nature of the universe? Where are we going? What's the origin of time? And so on. But then over time, I sort of naturally mellowed from that slightly extreme starting position, and I did explore the city in actuarial firms and accountancy firms in summer jobs, but I ended up concluding that it probably really wasn't going to be for me. And I decided that I was going to try and become an academic. And so I realized that to do so, I needed to get a little bit better at maths. And so I went off to the University of Oxford to do a master's in applied mathematics. And it was really there that I kind of got influenced by some very enthusiastic classmates that I met who were already super into financial mathematics, which is essentially the application of stochastic calculus to price derivative securities. At this stage, I still hadn't even heard of what a derivative was, but I think their infectious enthusiasm kind of rubbed off on me, and I ended up dropping into some of the classes. And when I got there, I was instantly hooked. I didn't know at that time that this would, derivatives would ultimately become a sort of lifelong passion, a career. Obviously, the topic of my first book, Volatility, Practical Options Theory, which I think we'll get a moment to discuss later on today. But at that time, I was really most interested in them from a scientific inquiry perspective, right? I think, if you think about what I'd been learning in science until then, you kind of have a system, maybe like a closed system. You have a starting point, you write down a model and you make some deterministic or probabilistic predictions for where that system might end up. The difference here was you have a portfolio, right? The system is the portfolio. That portfolio contains a derivative security. But in this case, you have the human who constantly kind of pokes this system in a process that we call dynamic delta hedging. And so, what you have is this derivative that is written on a stochastic underlying, right? It could be a derivative written on, say, the FX rate or the equity price or interest rate or commodity price, and it has a random payoff. You have the human constantly doing this delta hedging, and each one of those delta hedges has a random payoff. And somehow, the aggregation of all this leads to certainty, right? And that's a sort of super interesting concept when you first come across it, right? And now just to kind of take that argument a little bit further, let's say that certain number is minus $1 million that you end up with. The logic then follows that if you charge $1 million ex ante to enter into this derivative contract, that's therefore the fair value of this product, because your P&L will be zero with certainty at the end of this. So that's obviously the famous, the seminal Black-Scholes-Merton model and approach to derivatives. And I found that fascinating. Now, as time went on, and the ideas, it took me a while to really understand it. And as the ideas eventually settled in my head, I think I was left quite unsatisfied, with the main sort of confusion being, how was it possible that I and my classmates could be sat in the basement of a library in Oxford, totally removed from the real world? How could we be writing down a formula that would tell you exactly, how to perfectly replicate a derivative? If it was true that it was so simple to do that, then why weren't investors just, doing that themselves instead of trading billions upon billions of notional of these contracts every single day and across markets? Or why wouldn't, a bank or someone just market an algorithm that could do that delta replication for you, right? These things shouldn't exist, right? Now, I was in financial mathematics at that time, and financial mathematics sort of starts to give you some semblance of an answer, right? It says that the reason is that some of the conditions that are required for this perfect replication, namely that volatility is constant, right? Volatility doesn't move up and down, or that, you can trade your delta hedges at every point in spot space. Spot doesn't gap from A to B, but it moves in a continuous fashion. That's in the model. And in real markets, that doesn't happen. And so those conditions are not satisfied. And then financial mathematics goes off to do a load of useful things, right? It goes off and models that stochastic volatility. It models jumps in asset prices and does all of that. But it really falls silent, I think, on the questions that I was most interested in at that point, which were, why does volatility move up and down? Why do asset prices sometimes behave in a continuous way and sometimes in a jumpy, sort of gappy way? What causes periods of high volatility? Where does volatility even come from? Why do asset prices move at all? And so at that point, I realized that, to answer those questions, I really needed to learn some macroeconomics, right? And I needed to spend some time in markets. And so, I couldn't get onto a macroeconomics PhD program because I had absolutely no background in economics whatsoever. But what I did manage to do was convince an economist and a mathematician to jointly supervise me on a PhD project that was somewhere at the intersection of financial economics and financial mathematics. And so I went off to Imperial College London to start on that PhD. And it was really during the PhD program that I came across, let's say, the second topic that I've had another kind of lifelong passion for, which was this idea around risk premiums. Right, so loosely put, and maybe we can come back to this topic in a bit more detail. But loosely put, risk premiums are this idea that you never enter into a bet at its fair actuarial value. You always need a premium or a discount depending on how that bet is going to correlate with your own outcomes, be it whether it's a recession or a boom period, whether it's a period in which you have personal wealth or you don't, and so on. And that topic ultimately became one of the central topics in my new book, forthcoming book, Foreign Exchange, Practical Asset Pricing and Macroeconomic Theory, which again, I hope we'll get some time to talk about today. I kept on working on that project since. And then when I eventually got to the end of the PhD, again, I was kind of unsatisfied, right? Like I'd spent a lot of time downloading data, doing econometrics on data, reading academic papers and so on, but I really didn't feel like I had a proper understanding of markets or of derivatives beyond that level. And so and also, I mentioned earlier that I wanted to understand a little bit more about market microstructure and how markets actually behaved. And so I ended up deciding to try and get a job, and I was fortunate to find myself on the, I applied for some jobs, and I found myself at the FX options desk at Barclays Capital, as it was called at the time, in Canary Wharf. Now it was sort of amusing in some senses, because they hired me as a graduate, as a junior trader, whereas in my mind I was there on a reconnaissance research mission. I wanted to just observe how derivatives worked and how market microstructure worked and all of these things, so that I could eventually go back and write better papers on those things. But as these things happen, the trading floor is a super kind of addictive place, right? It didn't take long for me to fall absolutely in love with taking risk and trading. I think that there were a few things that really appealed to me. One, the kind of intellectual atmosphere and the ability to kind of discuss a huge wide range of topics with just people in your row, let alone the hundreds of other traders scattered across the trading floor. But the other one was, I just loved the productivity of the place. And by that, I mean that, we would sit there and discuss a trade or an idea for maybe 5 minutes or 10 minutes, and then go and actually implement that trade, right? And go and take risk. And we'd make money sometimes, and we'd lose money sometimes, and we'd kind of learn from that iterative process, which compared quite favorably at the time to the sort of 3 to 5 year process of publishing an academic paper. It was kind of mind blowing. And so I really enjoyed that. And then, I was hooked. And so, since then I traded options at Barclays. I was an FX Volatility Portfolio Manager at PIMCO. And of course, I am currently at Goldman Sachs, and that is where I've spent the majority of my career to date, and where I still trade today.
Great, that's a great story. And I should just add, all kind of your opinions you're giving on this podcast are just your personal opinions, not of any institution you're affiliated with. Just a couple of questions just come when I listen to you. There is, one thing in the economics field is that there is this notion of physics envy, that economists always feel like the physicists are doing kind of the hardcore work, so they want to copy the physicists and bring as much maths as they can into economic analysis. Do you have a view on that? Because you've seen kind of both sides of this.
Yeah, I mean, I think it's so look, I'm naturally pro a sort of more quantitative approach to work, but that's not because I take literally the numbers that would be spat out from a model. In fact, we never trade like that, right? It's all kind of ad hoc and based on what's going on in the markets and on the day. But any approach to economics, if you start with some assumptions and then you follow through a set of mathematics and you end up with some conclusions, right? That you can only then disagree with two things. Either you've made a mistake in the mathematics or your initial assumptions were wrong. Right. And if you don't take that approach, you can end up really kind of tying yourself into loops, right? You can kind of mix up cause and effect. You can mix up, you've had some kind of logical fallacy along your way if you've used words only. And so the way to think about it is to just, how do we use a set of equations or a set of models to make some prediction? Those predictions might not be quantitatively 100% accurate, but at least we've kind of followed through from our starting point to a reasonable ending point.
And I guess the other question, again, going back to physics, is, economic or financial markets are systems where you have humans involved. So you're both the observer and the participant, and you change the system, you come up with a model or pricing, and that affects the market, which is made up of people. And so it's this endogenous system. Whereas physics tends to feel a bit more, you're the observer and you can observe something outside of yourself, I guess, unless you get to all the quantum stuff and all the Schrodinger stuff, which gets a bit loopy. But how do you think about that it's this kind of circular system in some ways?
Yeah, so I think imagine, like, take the argument to the opposite limit. Imagine we use no mathematics. We try to trade options with no models and no mathematics at all, right? And we'd probably end up a lot worse, almost certainly, right? I feel much more empowered having a model with some predictions and some conclusions from that model when I trade, rather than having nothing at all. So we know that the kind of quantitative or mathematical approach adds some value, right? Yep. Based on that argument alone. And then when you say, yeah, there are humans involved, the model doesn't include everything, right? It doesn't include truly, you talk about endogeneity, but even completely like exogenous shocks, right? So say, for example, we might have a stochastic volatility model, but it didn't have COVID in it, right? It didn't
Correct.
have that kind of thing in a typical model. Maybe you can write down a model that does have it in it, but we wouldn't typically do that.
Yeah.
Right? So you kind of make adjustments to the model as you see the world, right? And that would be the adjustment process from going from a sort of purely physics-driven approach to maybe a more economics-driven approach. And naturally, with most things in life, that somewhere like that middle ground is probably the best place to be. Right, take the best of what a model and a prediction can give you, and kind of mix that up with your own view of the world.
And now you have this new book coming out, or has come out, or was about to come out, called Foreign Exchange, Practical Asset Pricing and Macroeconomic Theory. I've read a draft version, or at least half a draft version of it. It's really quite good. And rather than me talking about it, it would be good to kind of hear your thoughts on the book. But before we talk about some of the concepts you talk about, especially risk premium, which I think is very important, especially for investors to understand, is what was your motivation for writing the book? Because you didn't have to write this book. So why did you write this book?
Yeah, so I think so like on the motivation side, I guess there are two sort of sides to it, right? There's the consumer side, right? Like, what gap was I trying to fill by writing that book? And there's the kind of producer side, like why would I personally want to sit down and do it? So let me start quickly with the kind of what gap I was trying to fill there. So I'd say that there are really two gaps, right? One is, and you mentioned it a little bit already, this concept of the risk premium, right? We have had this idea in, let's say, in the academic space for many years, that the risk premium is actually the dominant component of asset price movements. I think that practitioners are really familiar with that. You go into work one day and equities prices are down and yields and US yields are lower, and the high beta currencies, Aussie, Kiwi, Canada, Norway, etc., are weaker. The safer haven ones, the dollar, Swiss, yen, to some extent, the euro, are stronger. We would call that a risk-off day. And if the opposite is happening, we'd call that a risk-on day, right? So practitioners kind of have this loose idea about risk premiums, and they kind of talk about them. Academics have this idea about risk premiums. But what I thought that there was a real gap in was, the kind of academic approach to risk premiums, the more quantitative approach, sort of introducing that to a practitioner audience. And by that, I mean, where do these things come from? They come from utility functions, consumption smoothing, investor optimization behavior. If you can kind of put those ideas into practitioner language, while practitioners kind of already understand the concept, they can improve their trading even further by kind of understanding the origins of that macroeconomic origins of that concept. So that was something that I thought was a big gap in the markets. To kind of give you perhaps a slightly more specific example, to kind of bring that point home a little bit more. If you think about, say, the financial crisis, right? At the start of the financial crisis, it started as a US crisis. It was a US mortgage crisis. It was a period where the US was running substantial current account deficits, 5-6% of GDP. By all kind of fundamental economic analysis, you would conclude that the dollar needed to weaken on that, right? Either from a growth perspective, because it was a US crisis, or because investors should be less inclined to lend money to the US. And so from a balance of payments perspective, your economic theory might tell you that the dollar should weaken. Now, we all know that the dollar strengthened substantially, and it did it again in the pandemic, right? And so, that is the risk premium being the dominant component of the currency price movement over the kind of economic fundamentals, right? And so I think that gives you some justification for really focusing your attention on the risk premium.
And I think your book really does give us a much better understanding of that from both sides, the theory and the academic side and the practitioner side. Now, this idea of risk premium, we kind of hear that a lot in markets. So, many people, even if they don't know the word risk premium, they talk about, it's a risk off day, it's risk selling off, and they intuitively know what's going to go up or down in that scenario. Then equally, you get all these asset managers and hedge funds who put on risk premia strategies. So the idea is that they, find different corners of the market that offer what they call risk premium, and then they implement that strategy sort of systematically. So there's a lot of either intuitive understanding of this or an explicit discussion of risk premium. Now, I guess, so this tells me it's very important, number one. But secondly, it's not clear to me whether everybody really understands what risk premium is exactly. So it'd be good to hear how you define risk premium, and then maybe we can go from there.
Yeah, sure. So maybe the easiest way is if we do it by an example. Maybe I can do a little game or a little bet with you, Bilal. To try and do the concept. So let's do a little bet. So let's say that we're going to bet on a toss of a coin. It's a fair coin. If it's heads, you give me an umbrella. Okay. Yeah. And if it's tails, I'll give you an umbrella. Okay. Sounds like a fair bet, right?
Yeah.
Like, you're happy, I'm happy. It's perfectly symmetric. We go and do that bet. Right, now, let's change it slightly. Like, I turn on the radio, and the forecaster says that there's a 50% chance of rain tomorrow and 50% chance of sunshine. And I say, okay, Bilal, well, you're happy to bet umbrellas at 50-50 odds with me. So why don't we say, if it rains tomorrow, which it will with 50% probability, you give me an umbrella. And if it's sunny tomorrow, I'll give you an umbrella. All of a sudden, you're a lot less happy with that.
Yeah.
With that bet, right? You're not going to do that bet with me now. That seems pretty unfair, right?
Yeah.
So now, well, what can we do? So I can maybe sweeten the deal for you a little bit, right? I can say, okay, you're not going to bet with me like that. That tells you that, really, it's not the actual odds of the bet that are your main concern. It's the correlation of the payout with the state of the world. You don't want to bet something where you're short an umbrella when it rains.
Yeah,
right?
yeah.
So what we can do is we can sweeten the deal a little bit for you. So I can say, okay, if it rains, you give me one umbrella, but if it's sunny, I'm going to give you two umbrellas. Okay. Yeah. And that bet, you might now take it. So you say, okay, well, if I'm unlucky and it rains, I'm going to get rained on. But if it's sunny, I get double, the payout. I'll get two umbrellas, and I can use those umbrellas in the future on another rainy day. I might be able to sell one of them, or trade one of them for something else, and so on, right? So now let's say you accept that bet. Right. So now an actuary comes along and says, okay, well, I know it's a 50-50 chance of rain, but it's trading at two umbrellas to one umbrella. So the market implied odds of rain are actually 66%. They're 2/3.
Yeah.
Right? Now that difference between the objective probabilities, the 50-50 objective probabilities of rain, and the market implied probability of rain, that 66% chance of rain that's implied by the rate at which you and I have traded these umbrellas, that is what we would call, risk adjusted probabilities, or, the risk premium, or whatever you want to call it, right? It's when asset prices trade away from their objective probabilities of the objective probabilities of the payoffs, and trade at some kind of premium. That's kind of where the equity premium comes from, right? The equity risk premium is very well known. Equities return something like 8% on average since the Second World War. Why do they do that? Because we know that when it rains, equities go down, right? And so you need some kind of compensation for that. And so they end up getting systematically underpriced. We call that a risk premium. But I think, the umbrella example kind of puts it into your daily
that's
life.
a really good point. So what I'm kind of hearing there is that if you just look at the odds of something objectively or in isolation, that's one set of expectations of the price or probabilities, you could say. But then if you put that in relation to a state of the world and how you feel about that state of the world, then suddenly that introduces this idea of risk premium, where you'll suddenly think, actually, the price of that now can diverge from this objective probability. So that something that I think is more valuable to me in a bad state of the world could be worth more than something that isn't helpful to me in a bad state of the world, for example. And then that starts to impact the price.
Yeah, that's exactly right. And the microeconomic foundations of it are from essentially kind of smoothing your utility over time, right? Like in this example, you having an umbrella when it rains. When it rains, you're unhappy, and the umbrella offsets that and makes you happy. When it's sunny, you're happy already. So being short an umbrella doesn't, that will dampen your utility a little bit, because you have, obviously you prefer having an umbrella, owning an umbrella, to being short one. But essentially you smooth that utility over time, and that's kind of the microeconomic foundation.
Yeah.
Now in the book, I talk about this in more detail. I kind of use that utility function and consumption smoothing and all of these things to derive the result a lot more formally. And I go on to give a few more kind of market-based examples rather than umbrella-based examples of the risk premium, how it impacts equities and FX and just in betting markets and so on.
But this really tells you that there is something real here. This risk premium is based on something real. I mean, it's not something just made up, and it's a way you can earn higher returns over time, but it's compensation for something. There's a risk there. You're being rewarded for something.
It's not just, that's absolutely right. I mean, it's not just real. It is the dominant, in my view, and I would say, the dominant thing in asset markets. The amount of time that we spend on analyzing, say, the fundamentals. Say we look at currencies and we analyze, what's European growth going to be, and what's inflation going to be, and so on. Whereas the bigger price movements are driven by the risk premium. And I kind of bring you back to the example of the dollar at the start of the financial crisis. It sort of shows that that was the case.
And I guess that's why so many funds, asset managers, focus on risk premium strategies, because they're aware that this is the dominant source of making money over time, rather than trying to come up with a better view of fundamentals.
Yeah, exactly.
Yeah. And I was going to just ask, you said currencies there. So how does risk premium apply to currencies? Because, we can see how it applies to equities. You want to be long equities, but in bad times, equities really do terribly. So there has to be some compensation for that. How does that apply to currencies?
It's a tricky one in currencies, right? So, I think I take it, the way I look at it is that I know that in bad times, the dollar, the Swiss, the yen, the euro to some extent are going to strengthen, and Aussie, Kiwi, Noi, CAD, etc. are going to weaken, right? In economic bad times, and vice versa in good times. Now, the reasons that happens are quite difficult. In the case of the dollar, people cite all sorts of things, right? So you'll be able to read things like, oh, the dollar strengthens in pandemics or in financial crises, or in recessions, because in global recessions, because the dollar is this premier reserve currency, because it's the premier currency in international payments and so on. But then those reasons don't really apply to the yen and the Swiss to that extent. And actually, yen strengthens more than the dollar, and Swiss strengthens more than the dollar in typical sort of global crisis periods, right? We saw that again in the early stages of the pandemic and so on. So I don't know why, right, these currencies are the ones, and again, we could probably come up with some reasons, right, and if we had to, but we know that they do, and if they do, then we need to ex ante price that into those currencies. Right? If the dollar is ever trading cheap versus where its, say, fair value is based on some sort of, let's say, some PPP or PPP adjusted model, you need to be buying the dollar. That's too cheap for the dollar, right? You need to be paying a premium for the dollar. This is an old phenomenon, right? This is what Valéry Destin called, former famous French finance minister and then president, called the exorbitant privilege of the dollar, right? The fact that US interest rates could be lower than where they should otherwise be, that the dollar can be stronger than where it should otherwise be. Essentially, it's a risk premium based argument.
Yeah, so there's this sort of excess sort of demand for dollars because of safe haven properties, and so as a result, in this case, in this example,
I mean, maybe that. Yeah, exactly. That's right. But that demand is there at all times, right? It doesn't need. We know that the dollar, the Swiss, the yen are going to strengthen in the rainy state of the world, and so we need to price those currencies at a premium in the calm state of the world as well.
Yeah, absolutely. Yeah. So one kind of one popular way of thinking about this is the so-called FX carry trade, which is a strategy that's very common. It's probably the most popular strategy in FX markets, where you buy high interest rate currencies, which often are emerging markets, but also sometimes G10 like Australian dollar or Turkish lira or Brazilian real, and you borrow in the low interest rate currencies like the Japanese yen or the Swiss franc. Then you end up with this nice carry trade. And that, I suppose, is you're trying to capture risk premium there by investing in that carry trade.
Yeah, to some extent. I mean, I guess I would kind of append that with what you should be doing is buying in the high real interest rate currencies, right, and selling the low real interest rate currencies, and then depending on the correlation of those currencies with, with the state of the world, you should then be adding on a risk premium on top of that, that real interest rate differential that you're trying to capture over time. And the more the currency is positively correlated with, say, markets, the higher premium that you need to attach.
Absolutely. And I guess this kind of leads to a kind of an associated question, which is how do you determine whether something isn't offering you a risk premium? Because you could fall into this trap where anything that goes up over time, just empirically, you'll say, okay, that's a risk premium, so I'll implement that as a strategy. I mean, how do you think about trying to distinguish between things that offer true risk premium and things that are just went up over time and it's just data mining?
Yeah, so exactly. I mean, currencies have a bit of an anchor, right? So, I mean, if you think about a very stylized model, like a sort of hypothetical model, right, where you have two countries, let's just call them US and China, and they both produce goods, and they happen to produce the same, goods of identical quality. We'll call them US widgets and Chinese widgets. And and let's say also we end up with a world in which you can transport these things frictionlessly across the two countries, with little transaction, with little transport costs. Then that the real exchange rate needs to be at 1, right? In the let's say some forward. Let's say if I say, where's the 1 year dollar CNH forward trading, and that needs to imply a real exchange rate of 1, right? And so that would be the anchor point. Now from there, you obviously.
And that, just to be clear, that's a bit like the so-called Big Mac index, although the Big Mac's not tradable, or iPhone index or something, where we publish this iPhone index where we look at the price of iPhones in different countries. And in theory, when you do the currency conversion, it should be the same price, but it's not. Maybe transport costs are different, tax, there's all sorts of different reasons. But as you said, if you lived in a world where there were no transport costs, no frictions, no sort of tax differentials, then the price should be the same. If it's not, then there's an arbitrage possibility. And then that should just make sure people will just buy it in the cheap country and sell it in the more expensive country. And that would cause the currency to move in a way to equilibrate that all.
Yeah, exactly that. Now the issue that you have is that in that model, actually, if there were genuinely no transport costs, and then the real exchange rate, then there actually is no risk premium, right? Because with set like FX net, real exchange rates never move. Real FX rates never move because they just fixed at 1. And if something doesn't have risk, then there's no risk premium, right?
Yeah.
But that that discussion kind of gives you the origins of this idea that the real exchange rate should be something around 1, right? And maybe right, and then there are various reasons that it's not quite 1, right? And we can kind of go into where real exchange rate volatility comes from as we move on, talk about volatility more generally. But we say, let's anchor the real exchange rate at somewhere around 1. And then we say, okay, well, we know there's risk around this real exchange rate because some of these conditions that we just mentioned, like perfect, no transport frictions, don't hold perfectly. And so we say, okay, well, the real exchange rate on the forward should start at 1, but then we know that there should be a risk premium, right? And let's say it's US and China. Typically, the dollar is the one that strengthens in that carries the risk premium. So we need the dollar to be a little bit expensive, right? So the real exchange rate US versus China should trade in favor of the dollar by a certain amount, right? And let's say if there's a 5% risk premium, it should be kind of 5% expensive. So you say you put in your inflation expectations in the US, you put your inflation expectations in China, you calculate where dollar CNH forward should be. based on 1 plus, say, 5% risk premium plus your relative inflation expectations. That tells you where the nominal forward should be. Then you use covered interest rate parity to discount that back down to spot. Obviously, the higher a country sets its real interest rate, the stronger the spot is going to be on that discounting on using covered interest rate parity, and you work out therefore your fair value of dollar China today. Right. And that's the process. Now I kind of go into that in more detail in the book. And I think that in some ways the book is unique in doing that, because many books will do PPP, they'll do covered interest rate parity and those kinds of concepts. Most of the books that are written on risk premiums are actually written about, say, like equity markets.
Yes, that's right. Yeah.
So I think the nice thing about foreign exchange is that, asset pricing macroeconomic theory, is that it puts in, it puts all of those things together: covered interest rate parity, inflation differentials, real exchange rates, and the risk premium, all into one kind of coherent model, and tries to explain those ideas.
And it's really, really helpful. Yeah. And just to be clear for our audience who sort of may not be familiar with some of these terms, when we say PPP, we mean purchasing power parity. And it's a way of valuing currencies based on, you could say, like the Big Mac index or an iPhone index, that's in principle based on that. And then covered interest rate parity tells you how you calculate the value of FX forwards, linking it to interest rates between different countries, so you can work out what the FX forward is.
So exactly, and what I'm arguing here is you actually do it the other way around, right? You work out the forward price, and then you use CIP to discount backwards to get the spot price.
Exactly. Yeah. Now, you did talk about currency volatility there, and so this may be a really silly question, but where does currency volatility come from?
So again, it's a really good question. Ultimately, the discussion we've had already, we've kind of already argued that, the FX rate, you have the real exchange rate, right? And then on top of that, you have some kind of adjustment for inflation to get where the nominal exchange rate is meant to be. So there are two components to that volatility. And the discussion that we've had already, we've kind of already said that ultimately real exchange rate volatility has to come from the fact that we do have transportation costs across the world. Like we already said that if you've got the US and China, and they're both producing widgets, and these widgets are of identical quality, and you can transport them frictionlessly and free between the two countries, while the real exchange rate can never move, right? It's one forever with certainty. So that means that, we ultimately, it's the fact that you can't do a real goods arbitrage in practice that allows kind of real exchange rates to move. So now let's think about an example of where that might happen, right? So let's say the real exchange rate is 1 because we started in the world with perfect transportation, and then all of a sudden we impose massive tariffs, right? Like we go infinite tariffs. China, can't send any goods to the US. US can't send any goods to China. There's not going to be any more trade between them, right? Now let's think about what happens. So now let's say all of a sudden one of these countries suffers, or not suffers, but gains a productivity shock. Let's say China suddenly produces widgets with the same, twice as many widgets, right? Big technological improvement, and suddenly it produces twice as many widgets. Now, what would have happened before these big tariffs were enacted is that those widgets would have been kind of exported across out of China, and the global price of widgets would have come down such that the real exchange rate stayed at 1. But now widget prices in China come down because there are twice as many of them, right? And widget prices in the US stay where they are. And so what you've got is you've actually got China starting to look very cheap, right? The real exchange rate is moving in favor of the US because, one US widget is the same price, but one Chinese widget is half the price of what it was. And now, if you think about it, this is something that just comes out of the models that, the models that we were speaking about earlier, these kind of models of investors optimizing their portfolios across countries and international economies, and utility optimization and so on, and the book goes into detail about those. But if you think about this model, it's actually quite familiar. The outcome of this little discussion is quite familiar to a lot of economists. A lot of economists would cite a slightly orthogonal approach, say maybe the Balassa-Samuelson approach to FX. And in the Balassa-Samuelson model, what we've done here is we've said that in the non-tradable goods sector, because we've made everything non-tradable, so it's the non-tradable goods sector, we've hugely increased productivity, right? And therefore the currency should weaken. You normally think about that the other way around, right? You think about the Balassa-Samuelson model, an increase in the tradable goods sector, productivity causing the currency to strengthen. So it's just the other side of the same coin of that model, right? And so again, it's something that I really like about this kind of investor optimization approach. It gives you maybe some pretty intuitive ways to get to some of the conclusions that you might have had or heard from in other models of FX in the past.
And so, I mean, can you separate out the real side of things and the normal and the inflation side of things on the volatility side? So what you've said there is that, through introducing things like transport costs, through introducing ideas of productivity, that suddenly would influence the real exchange rate and introduce some shifts in its value and introduce some idea of volatility. How does inflation come into this all?
Yeah, so let's take the other extreme then. So let's say that the real exchange rate was fixed.
Yeah.
Right. So you could transport everything. So then how does FX move? Well, then it only moves from inflation. Because let's say if the prices of US widgets double relative to Chinese widgets, because US inflation is very high compared to China, then, for the real exchange rate to stay at 1, well, the forward price of the dollar therefore has to weaken. Right. So the nominal price of the dollar has to weaken such that the real price of, widgets still trade at 1 for 1. So that would be the component of volatility that comes from inflation. Now, if you think about this, let's try and put this into the real world perspective a little bit, right? So I'm gonna have a timeline that goes back, let's say before the pandemic, because the pandemic kind of changed things a little bit, but let's say, the last 30, 40, 50 years prior to 2020, really what we've had is a period of globalization, right? Transport costs have come down, barriers to trade have come down, tariffs have come down over that period. We had a little bit of, in 2019 and Trump and so on, we had a little bit of a blip in that kind of secular decline, but that is the direction of travel. And at the same time, the volatility of inflation differentials has usually come down, right? Especially in G10, central banks have broadly become a lot better at understanding how to control inflation, and we've had very, very stable inflation around 2% or lower in many developed market central banks over an extended period of time. And so if you think about those two components of FX volatility that we've spoken about, they've just been trending down and down and down, and that's really what you see in markets, right? If you look at where, say, FX implied vol trades relative to equity implied vol, rates implied vol, it's been on a downward trend more broadly, right? Now, it remains to be seen, but the components of the pandemic are potentially things that change that, right? In some ways, we had this long period of globalization. Maybe we have some kind of blip in that trend. People might become, we're sort of seeing a little bit of that already, but there is a potential for some halt in that decline. And we're already seeing a lot more volatility and inflation. Now, it's early days, and so I don't want to kind of make any big claims that this is a turning point. But I think it's good to understand these components of FX volatility and how they can be impacted by kind of.
It's a really good point. By having this discussion about what drives volatility, it helps us understand the trend in volatility as well. And so I've been in markets for like 20, 25 years. And as long as I've been in markets, people have always said FX volatility is too low. It should pick up. This will be the year it picks up. But as you say, if you have some grounding in theory and fundamentals and understanding of volatility, you'll see that, okay, you're right. Globalization has made things easier to flow between countries, so that stabilizes the real exchange rate. Inflation volatility has been going down, so on that basis there should be a trend down in FX vol. But as you rightly point out, we could be at a turning point right now. We'll have to kind of see. Obviously COVID, there's been lots of temporary factors, so we'll have to see what really sticks after that. But one question I did have was, if you look at inflation volatility or shifts in productivity or growth or all of these sorts of things, the volatility of these variables or these indicators, are not as high as market volatility, whether it's FX volatility, equity volatility. And so this is often called the sort of volatility puzzle, or whatever you want to call it. I mean, do you have a take on why are markets more volatile than fundamentals?
You know what I'm going to say, Bilal?
I know
the risk premium, right? It just further supports the point.
Yeah.
Right. Like the whole point of the risk premium is that asset prices can move around even if economic fundamentals are not moving around at all.
Yeah, which goes back to the umbrella example, so we're tossing a coin, the odds, it's always 50-50. That will always stay the same. But the value we assign to different states of the world could just fluctuate a lot and change, and the weather changes. And so that will
exactly. So let's do that example.
Yeah.
So this 50-50 is fixed. That's just a fixed number,
yeah,
coin,
yeah.
right? But like the more scared you feel, the more averse you feel, the more that 66 number goes higher.
Yeah.
Right. And the more that, the better you feel, if you feel like on a risk on day, feeling good about things, that 66 number could come lower, and the objective probabilities are not changing at all through that whole period. So you get that with a lot of volatility, right, for a world where the fundamentals just don't move that much.
Yeah. Now we've talked a lot about volatility, so we have to talk about options. And you are an options trader, and that's in your blood now. So I need to get some wisdom from you on this. You did write a book called Volatility: Practical Options Theory a number of years ago, which is an excellent book. One question, I suppose, is why did you find there was a need for writing this book? Because there's lots of options books out there already. So what was your value add, so to speak, with this book?
Yeah, that's right. So I published the book in 2018. So think about it like this, right? So the book is kind of written backwards, right? So in the sense that imagine you try to learn about FX options, or not just options theory, through a conventional method, right? You took maybe an MSc finance or an MSc financial mathematics or something like that, right? What you would typically have would be maybe a 12-lecture course. That course would start with the binomial model. It would go into some stochastic calculus. You learn about Ito's lemma. You learn about Gazanow's theorem. You learn about some partial differential equations. You'd use the Feynman-Cash theorem. 10 lectures later, you end up with a Black-Scholes valuation function. You then spend another 2 lectures differentiating that Black-Scholes valuation function to get the Greeks, right? And by the time you finished all of those 12 lectures, you've ended up really not being able to see the wood from the trees. Now, that work is all super important, right? Like if you're going to go and build a pricer, or you're going to do some sort of formal model, you need to know that sort of thing. But really, you're not really equipped to trade options in an environment that most market makers and investors find themselves in, which is where simplicity and intuition are a far greater value than mathematical formalism. Right.
And actually, that's true, because I've worked with many options traders, and they're not necessarily sort of hardcore mathematicians. I'm not sure if they could derive Black-Scholes, the actual market makers themselves, but they're extremely good options traders.
Yeah, absolutely. Exactly that, right? So the motivation for that book really came from looking around at my colleagues at Goldman, and thinking that, the people here are, true experts in options, right? Understand options like the back of their hands, but very few of us, some of us have gone through all of that math, but most people are using kind of heuristics, rules of thumb, the experience that they've gained on the options desk over time. They've all learned from their own seniors writing down a few scratches on a piece of paper, and so on, right? And in this kind of disorganized way. Now, not everyone can go and spend kind of 10 years or whatever sitting on an options desk. So what I wanted to do was write a book in almost reverse order, right? Give you all of the intuition, right? And only in chapters kind of 9 do I actually introduce the Black-Scholes and formal model. And I only really do that because I want to convince the reader that this book is rigorous. It's not a hand-wavy explanation of options. One way of thinking about it is to borrow a little bit of lingo from like Thinking Fast and Slow, right? A typical book will train your system to, right, your kind of deep quantitative approach of thinking about options, and it does very little for your intuitive, fast sort of system 1 way of thinking. And that's really what volatility practical options theory tries to do.
And when I started off, in finance, I mean, it was a number of years ago now, but the books that I read were the Taleb Dynamic Hedging book, and then the Hull futures and options book. I can't remember the full name of it, but those were kind of the two books that I was told to read, and I read them, and they were good. And the Taleb book was a bit more practical, nice, funny examples, and written in the sort of Taleb-esque style. And the whole book was a bit more sort of serious. I mean, what's your view on those sorts of books?
I mean, they're excellent. I think we might be a similar-ish age, so I'm probably read those books out around the same time that you're reading those books. And they were kind of, obviously very formative and very, very helpful. I think, they're also quite old books at this point, right? And classics, but I think, we probably, the world moves on, markets move on, and we have perhaps different ways of thinking about things, as time goes on. I mean, one thing that's definitely happened, and certainly in my experience, is that pricing and like decision-making times have come down a lot, right? Really have come down a lot. You have minutes to make decisions now. Markets have got quicker, and so on. And so I think one of the key things that I try and do is give you ways of analyzing options in seconds or minutes. Now, that's obviously very obviously useful for a market maker where you're sat in the market and you have lots of things going on. Even if you're an investor, though, and maybe you have, you can trade a little bit more on your own time scale than a market maker. I think those ways of thinking are still super, super useful, because anything that really brings down the bar to you thinking about an option, like if you can do something in your head that you can do with 90% accuracy and not have to use a pricer, you're probably just much more likely to go and look at a vol surface and come up with the trade that you wanted to do, because you've taken out so much of the extra work that you would have to do. So I think it's useful from that perspective at all.
Now, you mentioned these heuristics, or these quick ways of thinking about things, or rules of thumbs. Can you talk about a few?
Yeah, fine. Let's do one. There's like the best one, the one that I use every single day when I sit down at the desk. Really, what you need to do is just remember this one number, right, which is 4.2. It's the most important number in options. Okay. Right? So the formula for the break-even price on a straddle is just 4.2 times the vol, the implied vol, times the square root of the number of calendar days to expiry. And once you've got that number, you can actually make your decisions about options by just looking at a vol surface pretty quickly. So let's just do an example. Let's say
before you do that, let's just be clear, just for our audience again, what a straddle is. A straddle is just where you buy a call and a put, and so the payoff there is you basically want the market you're focusing on to be outside of the range of that, which would then be called a break even.
Yeah, exactly that. So you buy an at-the-money call and at-the-money put. You have a V-shaped symmetrical profile, payoff profile. You make money in both directions, but you need spot to move more than what you paid for this thing, right? So, and that's what you call the break-evens, exactly that. So let's say we're sat there, it's Thursday evening, it's the first Friday of the month, non-farm payrolls tomorrow, and you look at the vol markets, and overnight Eurodollar volatility is trading at 10 vols. So we just say 4.2 times 10 times the square root of 1, which is 1 calendar day till expiry, which is 1. So that's 42. So 42 basis points is the break-even price of that straddle. So now you can just think, oh, well, if I think, the data is going to move Eurodollar spot by more than 42 basis points, I should look at buying this thing. And otherwise, I should look at selling this thing, right? And
that's great. And 42 basis points is 0.42%. So if I expect Eurodollar or whichever market that you were referring to move more than 0.42% tomorrow, then I know it's attractive for me to buy that straddle, that overnight straddle.
Yeah, that's right. Now the book goes into a few more nuances, like there's a difference between break-even points and standard deviations, and things like that. And the book explains it. But to a good extent, you're kind of there, right? That's a great thing to remember. Now, in my own case, I'm not great at doing square roots in my head. So what I
don't think many people are.
So I mean, I just remember 3 points. I just remember, well, the square root of 1 is 1, so I know that one.
That's an easy one.
And I just remember that the square 4.2 times the square root of 30 is around 22. So I multiply 1 month vol. If 1 month vol was 10, that would be a 2.2% break even roughly. Okay, right. Yeah. And then the square root of 4.2 times the square root of 365 is 80. So if 1 year vol was 10%, then that's an 8% break even. And I just remember those 3 points, right? If I do a 3-month trade or whatever, I can work on that later. But when I look at overnight, 1 month, 1 year, in the market, I've kind of made a decision on what's going to happen today, what's going to happen over the next month, and what's going to happen on the more longer-term horizon.
And you can apply this to any market, isn't it? Because you're just looking at vol. It's not sort of based on just FX. You can look at equities, look at equity vol, and then you can work out what's the expected range or break even for Straddle for the next month. And then you can decide, do I think S&P 500 is going to be outside of that or going to move by that percentage or not? It's excellent. I love that. Yeah,
exactly that. I mean, it is just the Black-Scholes model rolled into one number. Like if you were to plug in zero interest, you just plug in zero interest rates, right? You plug in at the money, you set the strike to be equal to the forward. In this case, it's spot because I've set zero interest rates, and that number just becomes 4.2. So it's just a Black-Scholes with all the bells and whistles removed and simplified as much as possible. But it's probably the most useful thing that I've had in my whole time in the markets. I use it more than anything else.
And whenever I have somebody who has an options specialty on my podcast, I do like to ask them about this idea that options are expensive. So typically the implied volatility sort of extracted from the option price tends to be higher than the actual realized volatility. So it seems like when you're buying options, you're overpaying for options over time. And so, is this a problem? Are options always overpriced? And I'm going to guess what your answer is, but are options overpriced or not because of this implied vols above realized volatility?
Yeah, exactly. Like you said it, what I'm going to say. It's the risk premium, right? It's the volatility risk premium. So in this case, we know that volatility goes up on the rainy day. When it rains, the volatility goes up, and therefore I need to pay a premium for options relative to what they're realizing on average.
Yeah.
Right, they are the umbrellas. In the former example. So
does that mean should you buy options then, or I guess it tells you that the what we call expensive options aren't necessarily expensive because you're actually getting rewarded for holding the option for the event of these extreme events.
Well, it's not even, it's for the extreme events, but it's the fact that these extreme vol events are correlated with the state of the world, right? If you have, typically an extreme vol event happens when we're going into a bad period, like in the pandemic, volatility exploded higher, right? And you really pay because your consumption is going to be really low in the pandemic. We're going into a deep recession, volatility is going up. That is a hedge against that sort of rainy day, and so you need to pay a premium.
Yeah, so it's important not just to think about the bad outcomes, but also the correlation of that bad outcome with your portfolio or with your views of the world or your the world that you think you're going to enter into in the next period.
Exactly. I mean, you see that risk premium both in implied volatility versus realized volatility, which is what you mentioned, but you also see it in skew, in risk reversals and butterflies and other aspects of the vol curve that do very well when the world does badly. Those things typically trade out.
And how do you decide? I mean, obviously I'm guessing you're a bit biased because you make options, you're a market maker on an options desk, but when is it the right time to just buy the cash market? So just buy spots, or when is it right to use options to buy into a market? I mean, is there any kind of framework you like to think about to use to answer that question?
I mean, I think the risk premium framework can be quite useful, right?
Yeah.
If you worked out, let's say you did some analysis and you said that, okay, well, the risk premium in, say, Aussie dollar spot is only 1% or something like that, right?
Yeah.
But the risk premium in options is really high. Like the implied vol is 10, is maybe 20%, 30% greater than where the realized vol is. In that case, maybe you would, it doesn't seem that smart to do the option sounds like it's expensive, right? To try and hedge a bearish position in Aussie, right? You would say, okay, maybe I should just sell the spot in that case. So you could do a risk premium based analysis. Would be one way of looking at it. But I think it's kind of difficult to do in some aspects because I've kind of almost compared not compared like with like, right? Because when I talk about realized vol, that's a backward-looking thing. So really,
Yep.
if you replace my comment on realized vol with, my expectation of realized vol is significantly lower than where implied vol is, and my expectation of where the fair value of Aussie is kind of in line with where Aussie is trading, then I would prefer to maybe do the spot trade if I had a bearish position rather than to buy the option.
And what's your thought about the value, not the value, the benefit of using options to get non-linear payoffs? So the payoff structure is very different. You can get interesting payoff structures versus holding just a cash position where it's just linear to the price.
Yeah, I mean, ultimately, the fact that in some ways it's the same question, because the fact that the payoff is non-linear is what gives you volatility exposure in the first place.
Yeah.
Right. So if you've made a view on vol, you've kind of already said, oh, I want a non-linear structure. If I had a linear structure, it wouldn't have volatility exposure to it at all. The vega is a result of the convex payoff structure.
Yeah, no, that's a good point, actually. I've just asked the same question in another way, I suppose. Yeah, no, that's absolutely right. Yeah. And have you found that when you trade, say, less liquid options, like emerging market options versus, say, highly liquid G3, G10 options, do you approach that differently as a market maker or not?
I think you have to. But I don't think there's anything particularly unique to options in there, right? Because it's just like illiquidity in anything, in any asset, in any asset where, you can't get out, you kind of demand the risk premium, but and perhaps you could call it an additional liquidity premium, or you could bundle it all in with the risk premium, but there's some additional premium that you kind of demand to take the weak side of the market, right? The side of the market where you can kind of blow up. You demand something extra for that, and so that would apply to emerging market options. It would apply to a lesser extent to even to G10 options, which are very liquid, but say relative to spot, they're not quite as liquid as spot would be, and so maybe there's some additional premium built in for liquidity in there as well.
Yeah, no, that's great. Okay, we've covered a lot of ground here, and I do, recommend everybody get hold of the books to delve into these, concepts more. And I do think it's really important for people to understand these notions of risk premium. This is how the most sophisticated investors tend to think about the world. And also, it's important to understand some of the intuitions that we have around this all. And also volatility in options is incredibly important to be able to know when to use options, how options are priced, and so on. Now, I did want to ask some personal questions as well. One I always ask of all my guests is, what's the best investment advice that you've ever received?
So I think in my case, I'm a pretty broad believer in markets being pretty efficient, right? And so, as you know, I think the risk premium is really the main place to get returns over time. I think, one of my heroes in economics is academic is John Cochrane. I read pretty much everything he writes. And the advice based on that kind of approach to thinking is just buy your stocks, do very little with them, look at them 20 years later, and you'll earn a decent kind of return over time. And so I think for me it's just really buy something with a risk premium in it and hold it, and don't really trade it very much.
Yeah,
and that's kind of what I do. I mean, that's really what I've done. When I think about my kind of personal investments, I just buy stocks and I hold them, and do very little else.
I think there's a lot to be said for just having an approach like that. Now, the other question was, I talked about your motivation for writing the books earlier, but why did you decide to write the books in the first place? Like write books. That's not something you could have written a blog, but you've decided to go out while you have a day job to write a book.
Yeah, so I'd say a couple of things. So, I think it's a pretty solitary experience, right? You need some deep personal motivation, I think, to go out and write a book. And like you said, I have a busy day job and so on. So, staying up late into the night and trying to write and so on is quite a difficult thing to do. I mean, in my own case, there were kind of two reasons. One was I spoke about kind of how I might have become an academic, and I ended up giving that up to go into what I found more exciting at the time, which was going into markets. But I did still really, really miss that side of, you know, thinking and writing and publishing that you get from academia. And so this was one way of doing some of that. Now, it's not original research, right? It's not quite the same, but it's something that is sort of similar in some aspects to doing academia. And then on the other side of that, in my own case, I lost a lot of time. I was actually quite unwell during my PhD. I ended up losing significant amounts of time, maybe a year and a half of that period during which I would have maybe published a lot of my work. And I always had this deep motivation to try and, you know, make up for that. And when I think about it now, maybe it was could have been a better outcome. I doubt many people would have read my my PhD research, whereas maybe a few more people actually read the book, so that helped a bit.
Don't say that. You're going to demotivate every single PhD student now. I've got one guy on my team at the moment. He's doing his PhD, and I'm trying to motivate him to carry on and finish it.
well, in my case, it was perhaps, you know, they'll produce much better work than I was producing. So you know, in that sense. But I think, and I think the third thing was, you know, pandemics are actually very, very good times for writing books.
Yeah,
there's nowhere to go. I was working from home. My commuting time, you know, I found myself with an extra hour and a half a day, and nothing to do with it. So I kind of got writing on the second book.
No, that sounds good. The other question I wanted to ask was productivity hacks. I mean, obviously, sounds like you must have some system to, you know, keep your productivity so high. What's your secret?
Yeah, I mean, so one thing that I always found quite odd was how we go through life until the age of kind of 21, 22, 23, whenever we leave university, thinking that the best way to learn is to read kind of textbooks, answer questions, and do exams and so on. And then when we become adults, we think that, oh, we can just skim a page and, you know, read and you know, read a book here, read a book there, and so on. Now, I kind of found that a little bit odd, and I kind of realized that affected me quite badly. Like, I read a lot of books, and I think some great books. You know, when I think about, I don't know, I read The End of Alchemy, Mervyn King's book, which I thought was absolutely fantastic. But when I think about what I learned from that book, I've got maybe 4 or 5 kind of key messages from it that are in my mind, and very important messages. But I don't know how to really apply that knowledge to what I'm doing every day, right? And so what I've tried to do is actually read a lot less. I listen to books and audiobooks to try and keep up with that, and therefore probably absorb a lot less than if I'd read them. But what I do with my reading time is I try and read textbooks, and I'm a huge fan of online courses, you know, places like EDX, Coursera. I recently did a machine learning course, and I did the whole exam on it and everything like that. And I find that those ways of learning that you have when you are a student are still probably the most effective ways of building knowledge that you can then apply going forward as well. So I don't know if I would call it productivity hack, but it is that I essentially go a bit old school.
No, that's useful. Yeah, no, it's a very good idea, actually. I mean, then you really do understand the subject. Now, you mentioned a couple of books, well, one book there. So what are some of the books that have really influenced you?
Yeah, so I mentioned that one.
I actually had Mervyn King on podcast about a year ago to talk about that book.
I think I listened to that one. I mean his other book as well, with John Kay, Radical Uncertainty, is also is also fantastic. I think probably the single most influential book, I mentioned my kind of biggest influence in economics, John Cochrane, earlier. His book, Asset Pricing. It was published in 2005. It's a little bit old now, but it's still my kind of go-to in all things, in all things theory, and pretty much everything you write. I'd say is probably the biggest influence on me so far.
Great, no, that's excellent. Now, we talked about this book, the most recent book that you've written, Foreign Exchange, Practical Asset Pricing, Macroeconomic and Theory. Is the book out? And if so, how can people get hold of the book?
Yeah, so the book is available for pre-order on Amazon and elsewhere. We are printing at the moment, so hopefully within the next sort of month to 6 weeks, it'll be delivered.
Great. Okay, and I'll include the links on the show notes. And then your other book that you wrote a few years ago, Volatility, Practical Options Theory, that presumably is available on Amazon and all those good booksellers. If are these the best ways for people to learn about your philosophy? Is there any other way for people to follow you in some way or not? Do you blog?
Yeah,
or
I mean, I think. Yeah, I don't tweet or anything like that. I mean, I'm on LinkedIn if anybody wants to discuss anything to do with the books. I mean, I guess the other thing I should probably mention about the new book, Foreign Exchange, we spend a lot of time on the risk premium aspect of it. But the other thing I would mention about it is that it's got a lot of other things in it that practitioners practitioners new and experienced will find helpful. We spoke a little bit earlier about physics and economics.
Yeah.
One of the things that has struck me is that a lot of people enter markets from backgrounds in physics or engineering or history or something, but not really economics. And then we all try and assimilate some economics knowledge on the fly, right? We read research, we kind of learn things on the fly in quite an unstructured way. And so the other thing that the book tries to do, and really the second part of that book, is trying to give people who are either from an economics background and want a refresher, or people from a non-economics background, all of that theory that they kind of need to understand foreign exchange, namely interest rates, inflation, we mentioned risk premiums, purchasing power parity, real exchange rates, and so on. Put all of that into one organized and structured place, and kind of put it into a book. So I think it's a book really for practitioners on the risk premium side, but also on the economic fundamental side as well.
No, that's excellent. Yeah, and I'm going to buy the book for everyone in my team as well, so that because they often ask me what book should I read, and sometimes I have books that I read when I was first starting out, but as you said, things have changed. And I think from what I've read of your book, it really is probably the best, most sort of comprehensive book on FX, and also it strikes the right balance between that practitioner knowledge. It bridges that gap between the practitioner side and the academic sort of theory side. It's hard to find one book that combines both sides well.
Yeah, you say well. I mean, my worry when I was writing it was that the academics are going to complain that this is not rigorous enough, and the practitioners are going to complain that it's too academic, right? So that was my worry. But I've tried to pitch it in a place where hopefully I sort of satisfy and dissatisfy both sides, and try and get those kind of get the ideas across. As the main objective is get the idea across in the sort of simplest and most concise way, even if it's not perfectly expressed, which is really the idea in volatility as well, right? Make the approximations to give you the end result.
Yeah, no, that's excellent. So with that, thanks a lot for coming on the podcast. It's much appreciated, and good luck in the day job, and also in life as an author as well.
Thanks very much, Bill. Thanks for having me on. It was a real pleasure.